Okay, so now that you understand all of the individual advanced concepts, the next step is learning how to combine them with the base model that we talked about in the starter course. So the most important thing is to understand this. We're not adding random concepts, we're stacking confirmations. So you always want to start with the base model. Everything still starts the same way. We have the fair value gap giving the direction or any Q area, like the BPR that we mentioned, a breaker. We have a liquidity giving a target, so that's where the market wants to go to. And we wait for an IFVG to give us the entry. Now, where the confluences come in. Confluences are just additional reasons for price to react. That helps us filter better setups and increase the rating of a setup playing out. So for example, instead of just having a bias, liquidity, IFVG, we might also add an SMT divergence, a breaker block, a BPR gap, or a premium and discount alignment. Now, when multiple things line up at the same level, that's what we call a high confluence setup. Now, don't think I need to find every single concept. Just think how many things are supporting this idea. The more confirmations that you have, the higher the probability of the trade. Now, a very, very quick important rule, more is not always better. If you overcomplicate things and try to force too many things, you'll confuse yourself and miss the good trades. So just keep it clean. 2 to 3 strong confluences is usually enough. So the example flow would be your high time frame for value gap, giving your bias. You look for liquidity or a draw on liquidity, which gives you the target. Your price sweeps liquidity, and you get an SMT that confirms the weakness, and you have an IFVG that forms, giving you the entry. That right there would be an A++ setup. Now, a simplified view, our base model is our foundation. The confluences is added confirmation, and when you combine both of these, you get a high probability trade. That is how. Okay, so now that you understand how to combine the different confluences, the next step is knowing which setups are actually worth taking, because not all setups are equal. Some are high probability and some are lower in probability. So let's go through what a high probability setup actually is. So a high probability setup is when everything aligns cleanly. For example, you have a clear high time frame bias, you have a clean draw on liquidity, a strong displacement, a clean IFVG, and some added confluence like an SMT or a breaker. When multiple factors align, the setup becomes much stronger. But what is a low probability setup? So a low probability setup is when things are messy or unclear. For example, some choppy or ranging conditions. There's no clear direction, there's a weak displacement, some messy IFVG, or no strong confluence. These are the setups that often lead to losses. Now, the key difference is that it's not always about the setup itself. Sometimes it's about the conditions. The same model can be high probability in one situation, but then low probability in another. So before entering a trade, you want to ask yourself, is the direction clear? Is the target clear? Is the entry clean? And do I have confirmation? If the answer is yes to most of these, it's likely a high probability setup. If not, it's better to wait. Now, the important rule is that you don't need to trade often. You just need to trade well. I see a lot of people being impatient and ended up forcing trades, and this is the key killer to many of people's progresses. Just keep it clean, be patient, wait for a good setup, and then take it with proper risk management. Fewer high quality trades will understand how to identify clean IFVGs and how to enter them. Let's go into one of the core models that I personally use, the continuation model. The idea behind the continuation model is simple. The market is already moving in a certain direction, and we're looking to continue with that move. So we first start off with the higher time frame, usually the 1 hour, the 4 hour. We look for a fair value gap and use that as our bias. If we're reacting from a bullish fair value gap, we're looking for buys. If we're reacting from a bearish fair value gap, we're looking for sells. Now we look at where price is likely to go. We mark out the swing highs or swing lows, session high or session lows, and this gives our draw on liquidity. And in this example, we have the New York PM low. Now we drop to the lower time frame. On the 5-minute chart here, we have formed a 5-minute bearish gap, which we are currently retracing and tapping into. During this phase, we want to see a clean move, ideally a small pullback, and then a strong displacement lower. As you can see here on the 4-minute chart, we have a strong pullback into this 5-minute gap, closing at the midpoint, and then a strong closure back down, inversing this massive 4-minute gap here. And as you can see, price retests this 4-minute IFVG and continues lower. Now that we have confirmed this move, we can place our entry at the IFVG, stops above the high, and we can continue down to our draw on liquidity. So a simplified view, the high time frame gives direction, low time frame gives setup, IFVG gives your entry, and liquidity gives your target. And that is the continuation model. You're not trying to catch reversals or catch the bottom ticks or top ticks. You're simply following the current move with confirmation. This is one of the most consistent models because you're trading with momentum and not against it. Now that you understand the continuation model, let's go into the reversal model. Unlike the continuation model where we follow the current direction, the reversal model is about identifying when the market is likely to change direction. So we start the same way. We look at the higher time frame, usually the 1 hour, the 4 hour, and find a key fair value gap. And this is where we expect price to react from. Next, we want to look for a certain liquidity sweep. Before a reversal happens, the market will often sweep liquidity. This means that price will take out a previous high or low to trigger stops. This is important because the liquidity sweep creates the conditions for reversal. In this case, we have swept London low and create a strong displacement upwards, creating an IFVG. Once that shift happens, an IFVG will form in the new direction, and that is our confirmation. This tells us that the market is no longer continuing, but is now shifting. So as you can see in this example, we have a very strong downtrend coming down to London low. The market sweeps out London low and instantly reverses up, creating a strong IFVG off this leg here. This IFVG then gets retested, closes above the midpoint, and that is where you would have your entry from. You place your entry at the test of this IFVG, stops below the low, and your TP at your drawn liquidity, which in this case is the New York lunch high. So that's the reversal model. Instead of following strength, we're trading the shift after a manipulation. This model requires more patience than continuation, but when done correctly, it can be very. Now that you understand the reversal model and the continuation model, the next step is understanding liquidity and knowing which sort of liquidity is actually worth targeting, because not all liquidity is equal. Some levels get taken more consistently and some are less reliable. So let's go through the main types. So first we have the data wick liquidity. This comes from major news events, for example CPI, NFP, high impact news. These events often leave large wicks on the chart. These wicks represent strong reactions and a lot of orders that weren't filled. So from experience, price is often drawn back to these areas, so this is one of the highest probability types of liquidity. For example, here we have a 1 minute data wick low. This was created from a Trump tweet, which resulted in a large manipulation wick down, leaving all of these unfilled orders down here, which the market later came down to resweep. And vice versa, earlier here we had a data wick high, which left this wick high here, which the market then slowly crept back up to fill these orders. All right, next we have the session liquidity, and this is the high and low of sessions like London, New York, Asia, and these levels are important because they're widely watched and hold a lot of stops, and prices will often target these levels during the next session. Thirdly, we have swing high and swing low. These are just standard liquidity pools where price previously reversed from. They're still valid, but slightly less powerful than session or data wick liquidity. And if you're unfamiliar with swings, they're just simply these little swing highs and lows that the market creates. And finally, we have imbalances or gap fills. Now, this is where price returns to fill inefficiencies, like the fair value gaps that we've talked about previously. Important distinction here, we're not always looking for a full fill of the gap. Often price will just tap into the gap and then react, especially if it's a high time frame like a 4 hour or a 1 hour unmitigated gap, because once those orders are filled, price can reverse from. So instead of targeting the full gap fills, it's often better to treat the beginning of the gap as the draw itself. So in summary, from the highest to lowest probability, we have the data wick, session highs and lows, swing highs and lows, and imbalances or gap fills. And how we use this is when you're setting targets for your take profit, you don't pick random levels. You ask where is the strongest liquidity or where does the market most likely want to draw to? And that is where price is most likely to move toward. The better your target, the cleaner